Welcome to Analyzing Finance with Nick. In this video, I'm going to be discussing why persistently high inflation remains the biggest risk for markets and the economy. If you're thinking, oh, wait, wasn't inflation post-pandemic 2021 through 2023 problem? Fed hiked rates, inflation rates came back down, and we can now have a more healthy start to the economy. That's not really quite the whole story, unfortunately. In fact, if you really look at it, which is this chart I'm going to show you, which I think is the scariest chart in the market right now, is the fact that the pattern for inflation in the current decade is very similar to the buildup to the great inflation in the 70s. Uh, as you see, I'm going to show you this chart made by True Insights that's cited from the St. Louis Fed, where it compares the inflation cycle from 2010 to the present and compares it directly to 1966 to 1990. 1966 was kind of a pivot point because that's when the Vietnam War was kind of at its peak in terms of the pace of increase of spending to that war, as well as when the Great Society, which was the largest boost to the social welfare state in the United States since the Great Depression, was also enacted at this point. And so this guns and butter is what it was called, like this extra government spending with really no additional taxes or cuts elsewhere to finance it, resulted in sowing the seeds for the great inflation for the 70s. And in our generation, really, instead of the guns and butter policies, the driver for inflation was just high deficits, but accumulated with the stimulus from the pandemic. And the other thing that was in common with both of these eras was not just the large increase in fiscal spending without any tax increase to compensate for it, but you also had a slow to react monetary regime. In the 60s and 70s, the Fed chairs, including most notably Arthur Burns, were always late to the party in terms of hiking rates to fix the inflation problem because there were a lot of political pressures, particularly Lyndon Johnson, who is known for threatening to beat up the Fed chair if he didn't keep rates low enough to help keep the economy afloat while he was president. And that slow reaction function is what allowed the inflation to build up and stay persistent long enough that it got baked into expectations. And Jerome Powell had a similar situation where he eventually did do the right thing and raise interest rates to the level that they should have been in response to the conditions of the economy. Problem is, he probably did it about a year too late. And that lag was kind of enough for inflation expectations to start to get more baked into the economy. However, the break evens came down a lot more and didn't rally nearly as much as they did in the 70s. But there is an echo here. And overall, really, with this trend, as you see, like the baseline rate of inflation was about 2 points lower overall on average than it was from the 1970s. And like from the peaks of inflation, that spread was closer to 3.5 to 4 points. So if this analog was going to play out, when inflation peaked in the 15% range in the headline CPI in the early 80s, I think maybe the peak in this cycle, if we were going to repeat that pattern, would probably be closer to 10 to 11%. And I'm not even sure if we'll get there entirely, but if you wanted to have the repeat 70s analog, that's probably the bogey that you would want to shoot for. The other thing, though, that the 70s had, which was a big driver for inflation, is that you had this increased money supply. You had government spending hold up demand, and those are both in common. We have government spending holding up demand. If you see a lot of the jobs data, it's a lot of government or healthcare, social services, which are kind of connected to government in a way and is holding up the hiring, and that is helping keep up demand. You had a similar phenomenon going on uh, during the Great Inflation from the late 60s to the early 80s. But the other thing, though, that happened in the 70s period was you had one corner of the economy whose supply could not react fast enough to persistently high demand, and that supply would have shocks. And for the 70s, that was oil. You had geopolitical issues in the Middle East, particularly involving conflicts with Israel and then later Iran, that heightened the supply of oil. And this was at the same time when domestic production had peaked and was going down in the US. So there was nothing at home you could do to compensate for the decline in oil exports from the Middle East. And so it created a situation where oil and by derivative of it, gas prices were the driver of inflation, and also when those got high, caused the economy to choke multiple times because society just couldn't bear um, high energy prices and was slowed down by high energy prices. I don't think energy really is that asset class in this cycle. US production is going up, not down. There's a lot more sources of oil outside of OPEC, even if you include Russia now in OPEC plus, that, and we've seen with the recent geopolitical conflicts in the Middle East this time around, they barely did a dent to oil prices. So that's not really the driver this time around. I think that the swing commodity that is choking the economy this time is housing, particularly single family homes. And really, instead of international politics that holding down the supply, you had housing construction peak decades ago and remain low due to home builders getting burned in 2008. A lot of NIMBY style regulations preventing single family homes from being developed close to major job centers, and a lot of urban policy encouraging apartment buildings, whereas you have a whole generation who wants to live in single family homes, but due to lack of supply has been priced out. And even until recently, when apartment construction really started to boom again in the early 2020s, apartments were tight and rents have been held up too. And so now, instead of energy costs choking the economy, it's housing costs choking the economy. And whenever monetary policy gets too easy, instead of the first bid going into oil like it did in the 70s and hard commodities, it's now going into real estate. And then the rents go up because of more people trying to chase to buy houses, or investors to chase to buy properties, and or immigration coming in and increasing demand for housing. And there's not supply being built at the pace to compensate. And that's why rent, both like owner's equivalent rent and more public free market metrics, were high for the first part of this decade. The rent data has come down a little bit, but it's still stabilized and not really had much deflation after kind of bottoming out at the end of 2023. And then with actual housing prices, they had a small dip, but if you look at the Case-Shiller today, it's at 6% annualized, which is well higher than inflation. And with housing being 41% of core CPI, and many metro areas, the average American spending over 45 to 50% of their gross income on rent or mortgage payments, that is what's choking the economy. If you have housing inflation consistently going up faster than CPI, but wages not going up at the same pace, more people have to spend a bigger portion of their paycheck just to keep a roof on their head, over their head, and therefore there's no spending to go around everywhere else. And so when you have a bull run in housing, the economy chokes, comes back down, inflation comes back down when interest rates go up to attempt to slow down housing appreciation. But then as soon as financial conditions ease, the first thing that's bid again is real estate. And if we haven't really, we've seen apartment construction increase, but we haven't really seen single family home construction increase enough to meet for demand, especially with the increased supply of money that's fueling the availability of cash to go to real estate, particularly in these urban areas, which tend to have the most restrictions on housing construction. And so it becomes a doom cycle until you see a bigger increase in supply that can wipe out the inflationary impulse. We saw this with the energy market, where after Middle East tensions smoothed out and you had high interest rates to choke the economy to reduce demand for energy and development of uh, supply in other places such as Alaska, Canada, and more expansion into other areas of the world outside of the Middle East, and then eventually later hydraulic fracking to boost production in the US. That stabilized the market, and now oil is not continuously going up faster than inflation and the economy is able to grow when energy as a percentage of people's budgets stabilize and decline to a sustainable level. The thing at this inflation cycle, if it is going to be a housing driven inflation cycle, you're going to need to have increased availability of single family homes in urban and suburban areas. And that could be either due to years of construction above demand finally coming online. We're kind of starting to see that with apartments in many cities, but you'll need more of it. Or you have demographic transition where a lot of the boomers who are staying in their houses pass away and they don't have any replacement buyer. You would need probably some sort of tight immigration policy would accelerate this. But unless if immigration is just completely unrestrained, even if you have like a historical average level of immigration in the United States, the supply demand balance will still be fixed through demographic transition. But given life expectancy, particularly among homeowners relative to those who do not own homes at the same age, that can be another 4 to 5 years away, which would line up with inflation peaking in about 2029, which is similar to inflation peaking in late 1979, 1980. And the other thing, though, that is different between now and the 70s, though, is that the Fed buckled and cut rates before the inflation fight was over. Like they allowed a higher low in inflation to persist than the previous norm. And we'll see if the Fed has the conviction to get inflation down. Like headline CPI is in the threes. Core CPI, depending on what metric you use, is in the high twos, low threes as well. If they are consistent and they keep monetary policy relatively tight until inflation drops below 2% in headline and below 1.5% in core, then I don't really see a repeat of the 70s happening. However, if the Fed cuts too early, like they were priced into cutting 6 months ago, and they went through with that plan and cut 75 to 100 basis points by the year end without a major recession taking place, then you get the risk of the 70s run, and instead of oil being the driver of inflation, it would have been real estate. So it's really up to the Fed to do the quote unquote right thing and keep rates high. And even if you have a mild recession, you need to have inflation dog just die. And they've surprised me to the positive side so far in willing to keep rates already high for this long and possibly raising them if you have the economy overheat. But then this is the thing I'm watching for as an investor, is the biggest real risk to the markets and the economy is persistent inflation. And the question is really is, will the central bank do the right thing? There's a lot of political pressure, especially with an election going on, to cut rates or to not raise them if inflation warrants it. And there's also a lot of political pressure to keep housing prices high. And so that's why a lot of these anti-NIMBY policies tend to be blocked on the federal, state, and local level, because there's a vested interest of voters who don't want their nest egg to get eroded for the better of future generations. If you like this more like real-time macroeconomic analysis type videos versus my more bigger picture theoretical ones, let me know and I'll do more of them. Like, subscribe, share, and thank you for watching.